If you've ever watched Shark Tank, you've probably come to the conclusion that your startup can only succeed if you have investors. But if you're early in the startup game and you're focused solely on chasing investors, well, I'm sorry to be the bearer of bad news, but you're doing this all wrong. Honestly, Silicon Valley and the startup community as a whole has a huge problem. Too many startup founders are operating solely to impress investors so that they can get funded, get cool write-ups on tech publications, and get big inflated valuations. And what happens to many of these startups? Well, they fail, or at least they fail to meet expectations. And it's not that investor capital is unnecessary. Most startups will need some type of outside funding at some point as they grow their business. But in the early stages, you shouldn't be chasing investors. You should be totally focused on generating revenue, leveraging every resource that you have to prove your concept before seeking out more funding from investors. The media often makes it seem like getting investment makes a company successful, but ultimately that's a lie. Funding doesn't spell success, and getting $1 million investment doesn't make you a millionaire. In fact, if you take a deal too early, it can actually work against your growth. In this video, I'll show you a few examples of what happens when startups chase investors and get too much funding too quickly. And then a few cases of the opposite. What happens when startups hold out and chase revenue instead of chasing investors? Honestly, in my opinion, half of Silicon Valley is only chasing an investment deal because it's popular. I mean, when you're hanging around a bunch of founders every day and all of them have millions of dollars in funding, it can be intimidating, like your startup is the odd man out. Then, instead of securing capital as a strategic move to progress the business, it ends up being like a keeping up with the Jones moment. It's kind of like when you're going to the bar and you pull up in your 2009 Honda Civic that's completely paid off, but everyone else pulls up in brand new BMWs that they owe $80,000 on. It looks like they're doing better, and they're laughing at you for driving your Honda that you don't owe anything on, even though you're in a better financial position than they are. Okay, you get the point. I mean, let's face it. It seems cool to get a huge 6 or 7 figure check and get that nice write-up in TechCrunch, but that check is gonna cost you, just like that BMW will. What happens all too often, however, is that companies raise funds before they've actually proven their product, before they've proven their market, their timing, and their marketing strategy. And then they use all the funds to experiment and hope to find what works, instead of using the funds to scale a proven business model. In other words, the money just becomes the fuel for them to fail faster or to quicken their progress down the wrong road. Let me try to put this in some perspective. So imagine that you have to get from New York to Los Angeles. You have a car, but it's going to take you like 30 hours to drive there. Your friend, though, has a personal airplane that he'll let you borrow, and that can get you there in just an hour. But you don't know how to operate an airplane. So now you have this new resource that you don't really even know how to use. So you start it up, you make it down the runway, and as soon as you take off, you crash and blow up. See, having a great resource only works if you know how to use it. Okay, maybe that was a bad analogy, or maybe it was a bit extreme, but I'm sure that you understand what's going on here. It's a lot better to go the slow route and actually get to your destination than it is to take some investors' money and then blow your business up because now you have the funds to make bigger mistakes more frequently. Take the startup Quibi, for example. Quibi was founded by Jeffrey Katzenberg, the CEO of DreamWorks Animation. Basically, Quibi was a streaming service dedicated to short-form content with videos under 10 minutes long. Since Jeffrey had a big name and had substantial CEO experience, many investors took the leap and invested $1.75 billion into the business before it ever even launched. Now, that's a ton of money for a startup, especially one that didn't even have a minimum viable product tested in the market. Quibi launched and got a ton of interest since they were offering a risk-free 3-month trial period. But only a small percentage of people using the free trial actually became paying customers. Even though they had around 5.6 million total downloads, only around 8% of free trial users converted into paid users. And after only 6 months, Quibi announced that it was shutting down, having lost all of the money it raised through its funding rounds. It would have been a lot more impactful for Quibi to have taken a deal for like 100,000 or a couple 100,000, and then built an MVP, tested it with real users, and received their feedback. They would have quickly realized that users aren't really willing to pay for short form content, and they could have used that information to pivot. And since they were able to raise $1.75 billion, it would have been easy for them to raise another couple $100,000 and develop new features that were a better fit for the market that they were intending to reach. Again, funding isn't really as sexy as it seems. It's way sexier to bootstrap or take just a little bit of funding and actually win in the end. And sometimes, even with millions and millions of dollars in funding, it still doesn't get you as far as you think it will. You've got these humongous plans on what your product is supposed to be, and it's so innovative that no one knows exactly how to build it yet. Like Scale Factor, for instance. Scale Factor was founded in 2014, and they received $100 million in early investment. It was supposed to change the game, allowing small businesses to replace their accountant with artificial intelligence. But AI is difficult to develop, and there are so many rules to accounting. Furthermore, if the artificial intelligence makes a mistake in the accounting records, it could have severe ramifications for the small business. The company made it 6 years off that $100 million, but in 2020 they closed. Former employees reported that human accountants in the company's offices and overseas at offices in the Philippines were actually doing all the work, not their artificial intelligence system. Even with $100 million, they couldn't bring a working product to the market, and that led to their demise. Now, obviously, funding doesn't guarantee success. What it does guarantee, though, is that you're going to give up a huge portion of your equity, or you'll take it out as a loan and you'll have a gigantic liability on your company. In the early stages, and especially before you put a product on the market, you shouldn't be spending your time chasing funding. Instead, you should focus on another source of money, which is revenue. If you're spending all day trying to sell investors and not spending all day trying to sell to customers, then you're just doing it all wrong. Instead, you should take a more practical route. You take the resources that you have, you develop the initial product, you sell it to early adopters, you give them feedback, and you use that feedback and that revenue to continue developing the product. Or you take your product idea, create a crowdfunding campaign, and see if people are actually willing to buy the product that you're intending to build. That way you build up brand awareness and revenue, then you can use that revenue to further develop the product. Now you have the funding you need and you still own all the equity. At some point, you actually have to prove that your product works and prove that there's a market for it. The handful of startups that actually succeed, they prove this before getting big investments. Then they use their big investments to scale what they've already proven. We talked about Quibi and Scale Factor and explained what happens when you chase funding instead of chasing revenue. But let's look at some cases of companies that did it right. But before we get there, if you're enjoying this video, slap the like button and subscribe down below. Your support helps the algorithm recognize our channel and allows us to get this information out to more people. So I would really appreciate it. Okay, let's get back to these examples. MVMT, a direct-to-consumer watch company, definitely did it right. The founders, Jake Kassan and Kramer LaPlante, they dropped out of college to start the company in 2013. And fortunately for them, they had no idea what venture capital was. And since they didn't know it existed, well, they weren't chasing it. Instead, they focused on sales, even before they had manufactured their first products. They listed their watch on Indiegogo, a crowdfunding platform, and raised $300,000 in pre-orders. That revenue allowed them to produce their first line of watches. They proved that they had the right product, a watch with a menial aesthetic and an affordable price. And they proved that they had the right marketing strategy. This was back in 2013, and things like podcasting and Instagram were still new to businesses as marketing channels. They utilized these channels to build incredible awareness about their watches and establish channels for acquiring new customers at a low cost. And at this point, I'm sure that they could have easily raised capital from investors, but they chose not to. Instead, they used their revenue to continue growing the business. And by 2017, they surpassed $70 million in annual sales. In 2018, they sold the company to Movado for around $200 million. At the time, MVMT's managers and their 40 staff members owned 100% of the startup, with the two founders holding the lion's share of the equity. And when they were acquired, the founders made a ridiculous amount of money. Had they taken a bunch of funding early on, they may not have made it. It's possible that they would have just built up a huge inventory of watches without the customer feedback that they were able to get through the crowdfunding campaign, and maybe they would have failed to create a product market fit. Or maybe they still would have succeeded and got the same results. You know, the acquisition from Movado. And then they'd make that $200 million and have to pay out 90% of it to their early investors, who would definitely own most of the equity. Initially, they probably weren't the cool kids when they attended startup events. When everyone else was talking about the $1 million investments they received and all the write-ups they got because they struck a deal, MVMT's founders were probably somewhere hiding in a corner. But in 2018, while most of their funded founder friends were likely out of business, MVMT's founders were splitting up $200 million among each other. Qualtrics is another company that waited to take on investors. The company was created way back in 2002 and is basically a web-based survey software that allows companies to perform market research. The company decided not to take any funding early on, and they managed to build the initial platform on their own. Within a span of only 12 months, they had landed over 20 business customers, like the Kellogg School of Management and Royal Caribbean. By 2006, which was only 4 years after launching and without any outside funding, they reached $100,000 in monthly revenue. Between 2009 and 2010, they landed around 1,000 new clients, including major businesses like Barnes & Noble and Zappos. And investors were literally beating down their door trying to strike a deal. When Ryan Smith, the company's founder, met with an entrepreneur friend, R. Duff Thompson, Thompson gave him some advice saying, when it comes to investors, don't marry anyone on the first date. And it was that piece of advice that kept Qualtrics from raising funds at that point, even though they had every opportunity to do so. And since they didn't necessarily need the money to continue growing, when they were ready to raise, they could do so strategically instead of jumping at the first offer thrown at them. In 2012, they accepted a $70 million Series A investment from well-established VC firms Excel Partners and Sequoia Capital. When talking about why they chose these partners, Ryan Smith said, "They really got the vision of what we were doing and were just as passionate as we were. We didn't just want to go with the highest offer. It was unanimous that if we were going to do this, these were the people we wanted to do it with." And with this funding, Qualtrics really exploded, serving thousands of clients who used the platform to create more than 1 billion surveys each year. In 2020, SAP purchased Qualtrics for $8 billion, putting the founders in an extremely strong financial position. Giving some advice to startup founders, Ryan Smith said, "Too many people think raising money is the destination. In our circumstance, it definitely wasn't. It was more about getting the right team in place to attack the world." And honestly, he said it better than I ever could, because funding isn't a destination. Fundraising is a strategic move that should help you take something that's already succeeding and scale the proven strategies that will substantially grow the business. If you chase revenue, investors will come, but then you'll be able to be strategic like Qualtrics, because you aren't reliant upon investor funds to keep your business progressing. But for you to make revenue, you have to first establish a product market fit. And while that probably sounds difficult, it's not really that hard. And we have a 6-step process that will help you create the optimal product market fit right here. I hope you enjoyed this video, and I'm looking forward to seeing you in the next one. Until then, take care and keep creating amazing shit.